Welcome to Creditversio's Q&A Wednesday live for March 1st, 2023. I'm your host, David Mahalik, and with me again is John Ulzheimer, formerly with FICO and Equifax. John, good to be back.
Thank you for having me, David. I appreciate it, as always.
We were off last week. We had a little bit of a growth moment in Creditversio, so we had to. It was all hands on deck, but glad to be back. Glad to do our Q&A today, and so as people jump on, I think we'll hopefully have some questions today. Last week or last time we were on, we got a bunch of questions. So we had a group that was very interactive, which is always a good thing. I always like to make it more about the questions than covering the subject matter that you and I talk about, because it's usually usually the same stuff we talk about over and over again, or at least over years and years. But so I thought I would focus the initial topic today on just the steps to build credit. So these are some questions that I got a little bit of. I got to man the phones again on Monday, so I was the guy doing all the customer service. My guy was out, and lots of questions about, okay, I'm recovering. I had a bad moment in time. A lot of the stuff that I've got is either getting ready to age off. It's 5, 6, 7, 5, 6 years old. What do I do now? What does FICO and Vantage Score ideally want to see? What's important when I'm recovering from damaged credit, some of which is still on my credit report? So I thought, what's like a practical approach to starting to rebuild and play the game a little bit better this time around?
Yeah, well, so there's no silver bullet, right? For some reason, there's this mythical silver bullet that's floating around in the credit world that people think if they do this, that, and the other, then all of a sudden they're going to go from FICO 570 to FICO 810 in a year. That just doesn't happen. The only way you can do that is essentially if all the bad things fall off your credit report, and then you may see some sort of a radical score improvement like that. So for people who are recovering after some sort of a credit disaster where their credit reports are loaded up with derogatory information, the number one thing that you want working in your favor is time. Putting time between yourself and all of those negative events. To the extent that they're accurate and you can't get them removed from your credit reports, they're going to sit there for up to 7 years, but they don't have the same value in your credit score the whole time. In fact, if you stop doing those types of things, meaning that you stop populating your credit reports with new derogatory information, you're actually going to allow time to become an ally of yours. And the older those derogatory entries get, and really what you're looking for is the most recent of those derogatory entries, that's really the key entry. You want that one to be as old as possible, because there are metrics in credit scoring systems that consider the date of your most recent major derogatory event. And so if you've got a collection from 6 years ago and a charge-off from 5 years ago and a repo from 6 years ago, obviously those are not going to be helpful. But if you've got a collection from 6 months ago, that's the big problem, because that is going to be the most recent major derogatory event. And so you haven't allowed time to really pass between yourself and the most recent of those derogatory events. So that's number one, is just putting time between. And actually, I just kind of talked myself into a credit repair strategy, even though that's not really what I do. So if you had to kind of grade various derogatory events, really one of the most powerful ways of doing it is to look at the one that's the most recent. So if you've got 5 charge-offs on your credit report, and those are the only 5 derogatory entries, and they're all equally derogatory because they're all charged off. But if one of them is 6 months old and the others are 5 years old, clearly the one that's 6 months old is the biggest problem. Doesn't matter what the balance is; it's the event. So I think that kind of should shift your target, right? Your crosshairs have to be shifted, considering, to the extent that stuff is wrong and you're going to try to get it removed. Then that's really something you want to do. Is number one is time. Number two is, and I hate to suggest that people get into debt, but remember, we are talking about credit scores. And credit scores predict the likelihood of you paying your credit on time in the future. And one of the most effective ways to prove to a credit scoring system that you can pay your bills on time is by paying your bills on time, right? And so, to the extent that you do want to hop back into the credit market, either with a loan or a credit card, one of the interesting phrases that I interviewed a guy from FICO last year just to get some attributions for some comments I was going to put into an article, and he actually made a really interesting way of phrasing something is some is better than none when it comes to debt. A lot or
Yeah.
a little is better than a lot, but some is better than none. So if
Yeah,
you've
that's a
got a
great way to
credit,
put it.
yeah, if you've got a credit report that has absolutely no debt on it, then number one, congratulations, because that's awesome. You're out of debt, you're not paying interest, and you don't have any lenders looming over your head, and you have the titles of your car and your house is free and clear. That's all fantastic. But again, you asked me a very specific question about credit scores, and so credit scores will reward people if they do have modest amounts of debt that they're managing properly. And that means low utilization. Again, a little is better than a lot, but some is better than none. That applies not only to credit card debt, but also to installment debt. I'm quite certain that the people watching this have either experienced for themselves or have heard of scenarios whereby someone pays off a car loan or pays off a mortgage and their score goes down and they're
Yeah.
perplexed. Why in the world? This is an enigma. Why in the world is my score going down when I'm getting out of installment debt? And the answer to the question is that you're actually rewarded for having low balances on loans relative to the original loan amount. Of course, right before you pay it off, it's the absolute lowest
Right.
relationship between your current balance and the original loan amount. So you're actually being rewarded for that. And once you pay it off, you don't really have that metric that the scoring system's like. And so
Yeah.
really it's a matter of time and then jumping back in the game, but maintaining really, really small amounts of debt.
Right. I see we got a handful of people here. Feel free to, I didn't say this in the beginning of the live, but feel free to introduce yourself. Let me know where you're from if this is your first time. And this live is all about you. If you've got questions about credit, about scores, not sure how things work, that's why I have, America's favorite credit expert on with me today. And we'll be more than happy to answer the question for you. So, John, when I swung back around, I kind of buried my head in the sand. Um, after I went through the whole, Great Recession, I was one of those guys that was just over leveraged and, didn't come out very well on the other side. But after I think about 2 years it took to recover, I'm like, okay, now what do I do? Money situation's solved. I've settled a lot of the debts that were kind of looming over my head that were real threats, like lawsuit type of threats, which is always a consideration when you have, even even a medium amount of debt.
Of course.
So my first steps was a secured credit card. I got some great advice. I had been off the grid for years. The only credit I had, like if I didn't have, if it wasn't bad credit, I would have had no credit. I mean, that's how bad it was on my credit report. And it was really a process of learning how things work and learning how to be responsible with credit. In fact, even before all this, one thing that I thought was pretty, I remember this moment today because it did stand out to me. This was probably 2004, and I was buying a new car, and I was with F&I, which I used to work on the F&I side before, and he came back with the interest rate, which was okay, but he said, "Yeah, we can't get you any better of a rate because your score is only a 680." And I'm like, "Wow, 680. I don't know exactly what that means. I thought it would be better because I was thinking at the time, well, it must just come down to like money. I had great cash flow, owned several properties, some rental properties. I'm like, doesn't that mean I should have a great score?" Had no idea what credit card utilization meant, had no idea what all this stuff meant. So I have a lot of sympathy for people who come to this and like, I don't understand why my score is what it is. But having to rebuild all over again, it was secured credit cards, and I think I had My Jewelry Club. Do you remember My Jewelry Club when they were around for a while? That was really big in the credit repair space until they stopped
Yeah.
reporting. I had that.
Yeah. Those
Yeah, yeah.
those membership club lenders where you could get a $5,000 line of credit for books or jewelry, and then they would furnish it to the at least one of the credit bureaus.
Yeah. They furnished it to 3 of the bureaus at one time, and then the Experian and Equifax are like, nah. I think we see what's going on here, and I think
Yeah.
TransUnion was the only one that ever had it. But still, I mean, it served its purpose at the time. So, um, so feel free to post a question if you like. So John, in the rebuilding process, one of the things for me that was always a little frustrating was just the time it took and how easy it was to have this up and down and up and down on the score, because again, also I didn't understand utilization very well either, and I think my one credit card had a $300 credit limit, and it doesn't take much to to max that one out. So for somebody
Right.
getting started, no credit or limited credit, what would be like your top handful, maybe 3 or 4 points that people should follow?
Yeah, I don't think a lot of people go into the credit building process. And notice I said building, not rebuilding. I mean, you only have one, you can only build credit one time, right? You build it once. If you screw it up, now you're rebuilding. So there's a difference between building and rebuilding. Um, Most people before the Card Act, anyways, so pre 2009, most people established credit on their own for the first time around the age of 18 to 21, because you were allowed to open a credit card. Credit card issuers were allowed to make an offer of credit to someone who was 18, and unless you were an authorized user on someone else's credit card account when you were younger than 18, usually that's where people's arc, the consumer credit life cycle arc, generally would begin between the ages of 18 and 21. The Card Act changed that. Now it's closer to 21 plus than it was back then. But really it was a matter of, retail store credit cards, petroleum or gasoline credit cards, and then really low limit unsecured cards. Like I think my first credit limit was $300 back in like 1987.
Yeah.
And so, but no one understands utilization, and no one is going to consciously make sure that they don't spend more than 20 or 30% of whatever their credit limit is. They're just going to use the card. And that's fine, because you may not need to have a really high score, because you may not be in the market for a home, or you may not be in the market for a car loan. You may literally just be on the front end of your life cycle, and you're just living and just kind of organically establishing credit for personal use, and that's helping to build a credit report. And then eventually you kind of realize, hey, I think I want a house. I think I want to borrow money to buy a car. I'm just now learning that there's this thing called a credit score that I need to focus on, and it's important, and it's going to change my monthly payment from this to that, or that to this, and I really want it to be as low as possible. So
Yeah.
that's something that generally happens between the ages of 20 and 30. But by then, if you don't have a credit report by then you are behind the curve, and that is just straight up accurate. Today, it's actually easier and pretty common that people are building credit for the first time with student loans versus credit cards, because you can't legally get a $500 credit card unless you have a cosigner or a job until you're 21. Right. But you can get a $50,000 student loan when you're 18, and most federal student loans have cosigners. I think the last statistic I saw is like 90% have cosigners. So they're cosigned or guaranteed by usually a parent. But nonetheless, that's usually how people are graduating from school, or at least leaving school, is with student loans and maybe 1 or 2 credit cards. And essentially that is the basis for what will become their credit reports.
Yeah, that's a real common thing that we see too. In fact, when I was doing customer service this week, lots of questions about student loans. Actually, you know what? That's probably a good topic to enter as well. I don't know. We've got a handful of people watching. Anybody want to discuss student loans? You want to talk about credit card utilization, credit scores, FICO, Vantage score? Let us know what you like to talk about, and we can we can expand on some of these topics, or we can change topics. It's completely up to you.
Can I suggest a topic?
Please.
Yeah. So
every time you suggest a topic, it's always going to be fun.
Yeah. So there's there's a CFPB report or press release that came out a couple weeks ago that I've been avoiding talking about because I'm gonna write an article about it this month for a client. But for those people who they're not credit historians, this is going to be interesting to you, but you may not understand the backstory behind it. So the CFPB, I think we all know that there's a uniform language used to furnish information to credit bureaus, and that language is called Metro 2. And Metro 2, the manual is like 350 pages long, and there's all these segments that make up trade lines or collection accounts on your credit report. Yeah. And one of the fields cells in an account, not a collection account, but a trade line, so an obligation that you have is the actual amount paid. So what is the actual amount paid? Well, it's one of the few things in credit reporting that's actually straightforward and means what it sounds like. So if you have a credit card and you paid $100 last month, then not your scheduled monthly payment, but the actual amount paid, then there's going to be a notation on your credit report that's going to indicate that you paid $100 for that particular month. That was the actual amount paid. And that's part of the trended data. Yeah. That 24-month history of your scheduled payment amount, your actual amount paid, balances, things like that.
And are we going to see this on our credit reports at some point in the near future?
It's been on credit reports for the better part of the last decade plus. But there are some credit card issuers, and there's a growing trend that the CFPB has identified, and they actually sent out a press release 2 weeks ago about their, kind of expressing their concern over this issue of where the actual payment amount or actual amount paid is being withheld by some lenders. So you see the balances, you see your scheduled monthly payment, obviously whether your account has been paid on time or not, the balances, the past due amounts, things like that. But the actual amount paid is being withheld. So the question is well, why? And is there a downside? And what is this kind of the CFPB's take on it? Well, the CFPB's take on it is that it's problematic for consumers if that data field is not filled in. The perspective from the furnishers or the lenders is that they feel like there's a possibility that poaching may occur if that type of information is on your account, because maybe some other lender can see it and make an offer that is more compelling to you, and therefore you may jump ship and go at them. And so you may be wondering, well, that doesn't make any sense. This happened 23 years ago. So for those of you who are not credit historians, you may not remember, and I'm not going to call them out, but there was a large credit card issuer in the late 1990s that withheld credit limits from credit reports. And when they started withholding credit limits from credit reports, it was like monkey see, monkey do. All these other credit card issuers, month after month, a new big credit card issuer started to withhold the credit limits from credit reports. And it became such a problem that FICO got involved and started doing analyses to determine what was this going to do to score distributions. The credit bureau, the CEOs of the credit bureaus were actually flying around the country, kind of making the story to these lenders that it's actually better that you do report this information than you do not report this information. Some of these credit card issuers were getting sued for withholding that information. I know because I was involved as an expert witness in at least one of those lawsuits. And so this is actually kind of that part two. And so we'll see what kind, and we're really on the front end of the curve of this issue. And so that we all know credit limits are components of credit scores, because in order to calculate utilization, you have to know the credit limit of a card. But the actual amount paid is not considered in credit scoring systems, even though it's cosmetically on a credit report so a lender can see it and consider it as a matter of policy. Or in a custom scoring system, it could be something that is considered. But it's not something that's going to affect your FICO score. It's not going to make your FICO score higher or lower, whatever that amount happens to be, or if that amount is missing. But nonetheless, the CFPB, which always takes the side of the consumer, of course, is questioning what is the motivation for this and what is the possible harm to consumers for them withholding this value. For those of you who are watching who have pulled your own credit reports in the past 10 plus years, if you keep those, and I'm talking about your actual credit report disclosures that you can get like from annualcreditreport.com or directly from the credit bureaus, look at them and you'll see this chronology of information for the prior 24 months. And one of those values is likely going to be the actual amount that you paid. That's the value that I'm talking about that is largely missing now from consumer credit reports.
Interesting. So what is so they think that showing the amount paid is going to allow creditors to
poach.
That's right. Maybe with access to that information, you can see, well, this person's making $200 or $500 a month payments or $1,000 a month payments on this particular card, and that's the kind of client that we want. Or this person's making minimum payments, and that's not the client that we want. Largely, is that the thought process behind it?
I mean, if you think about it, credit card issuers are for-profit companies, and in order to make profit, you have to have revenue, and credit card revenue is largely generated by fees and interest. Who pays the most interest on a credit card? The person who carries balances. They don't make a ton of money off people like me, because I pay my balances in full every month. So I'm what's referred to as a transactor, not a revolver. So I don't carry balances. So I don't even know what my APRs are because I don't care, because I don't carry balances.
Right.
So I'm limited to either annual fees. I have a couple of credit cards that have annual fees, so that's the fee income, or the interchange, so the swipe fee. So every time I swipe, someone makes a little bit of money from the merchant who has to pay the 2 or 4% for the privilege of taking that particular card. So I'm not a terribly profitable customer, and if you look at my historical actual amount paid, it's the exact same amount as my balance. So it's not hard to tell that I pay my balance in full every month. Therefore, I'm probably not the most profitable credit card customer. Conversely, someone who has a balance and is making the minimum payment, which is usually about 2% of your outstanding balance, but they're making their payment, right? So they're not going into default.
Right.
That is a really profitable customer, especially if they have really large balances and they're making just the minimum payments month after month after month. That's a really profitable customer. It's not a bad customer to go after if I'm a credit card issuer. So it's certainly something that it would be concerning if I'm a credit card company. I don't want people to be able to see who my best customers are, and they're going to try to poach them with some sort of really compelling offer, balance transfer offers, or whatever the case may be. So I get it. I understand why they're doing it. And ultimately, there's nothing in the Fair Credit Reporting Act that obligates any company to furnish anything to a credit bureau, and certainly there's no requirement to report the actual payment amount. I can promise you can look at the 90 some odd pages of the FCRA. I promise you, it's not in there. There's no requirement to report that information. So I don't know what the CFPB can do other than be mad. But I don't think that no law is being broken, I don't believe, but I'm not a lawyer, but I can't find anything that's statute based that suggests that you have to furnish that type of information.
Do you see this playing out the same way 23 years ago with all the credit limits being removed and all the chaos? I mean, that's a different animal altogether, because now we're talking about FICO. We're talking about, well, there's no Vantage score back then, but all of the it just really disrupts the whole scoring process, which disrupts the entire lending industry for the most part.
So here's what the credit bureaus did in response to that issue back in the late 1990s. They all implemented a policy which was, if you give it, you can get it. But if you don't give it, you can't get it. So if I withheld credit limits on my accounts, the credit reports I purchased would not include anyone else's credit limits. So I didn't give it, therefore I don't get it. So it removed the whole issue of poaching, because I couldn't see it anyways. And the only way
Yeah.
I would actually get it is if I chose to give it. And so then everyone was kind of on equal footing in that respect. So, there's a precedent that's been set with respect to what could the credit bureaus do to deal with this. And that could be one of the things that they do. If you're gonna get it, you gotta give it. And so they could certainly withhold that data field from certain furnishers that are choosing to not furnish that actual payment amount, which is exactly what happened 23, 24 some odd years ago.
Yeah, this should be very enlightening for those who are watching with a live or on a replay. Is that one of the things that we forget? It's easy to forget is that there's a real business model behind the purpose of credit bureaus. I mean, they're not just simply repositories of data to serve whatever interests that like our insurance company or mortgage company, but this data is out there and available for sale, and it's a big business, and that's largely the business model.
Yeah, I think people need. So a couple of things. So I kind of had this. I got in a couple of LinkedIn arguments this week because a lot of more people are getting more young people. When I say young, I mean people in their 30s. That's not young. I mean that's almost half their expected. That's almost half their expected life, the amount of time they're going to live. About that they're getting into more and more debt, and uh, my point is debt is optional. No one forced you to buy a $75,000 car or lease a car that's $1,400 a month. No one forced y'all to. No one made you do any of that stuff, right?
Yeah.
No one forced you to max out your credit cards. These are all choices, right? And choices are optional and voluntary. Just like
Right.
spending $50,000 a year in college to get a college, loans. That's all optional. And yes, I realize that people who have college degrees make more money in the long run than people who don't have college degrees. Not everyone goes to college that's $50,000 a year. That's not part of the advice to get a college. There's nothing that says, well, if you have a degree that costs you $250,000, you're going to make this. If you have a degree that costs you $50,000, it's going to. That wasn't part of the. That's not part of the geometry. So I kind of had this back and forth with some of these younger people who are just kind of mad at being in debt and try to take it out on me. But all debt is optional. And so I think if you understand the rules of engagement with lenders and with the credit bureaus, you may not like the rules of engagement, but at least you understand them and you're not going to get surprised by anything. I think too many younger people find themselves in a position where they do something and their credit card issuers do something punitive to them, like nail them with a fee
Yeah.
or decline a transaction or lower their credit limit or raise their APR. And it's almost like they're befuddled. Why would they do that? They're I've been with them for 5 years. I keep trying to remind me, look, they're not your friends, right? These aren't the people you hang out with on the weekends. You have
Right.
a contractual business relationship with these companies. And as long as you do what you've agreed to do in writing, then they're going to have to do what they've agreed to do in writing. And if you don't do those things, then they don't have to do. They're going to take punitive actions against you, which is they're going to nail you with fees and they're going to close your accounts. They're going to raise your interest rates. And so if you understand that there are these rules of engagement and you're not dealing with like a friend where you can kind of tell them, hey, can you cut me some slack? I'm sorry I was late. And it's okay because it's a casual type of thing, then you may not like the rules, but at least you understand the rules, and then you really don't have any excuse for breaking the rules.
There was this post that showed up on one of our Facebook ads, or no, actually it wasn't. It was one of our. In fact, now I remember it was a live that you and I did, and some guy went off on this rant. He's like, this is so unfair. The bureaus are out to get people, and I don't remember the exact language because it was kind of nonsense. But one of the things that really struck me was this complete absence of personal responsibility, and And one of the things that I've been telling people for years now is that, listen, that most of the people that are in the credit repair space, or are trying to fix their credit or trying to undo some damage, were born after the internet was created. We know we've been walking around with smartphones pretty much in this form since about, what, 2007, I think the first iPhone came out. So what is that, 15 years, 16 years, something like that? So to say that you don't understand how this stuff works, that you're a victim, that you're, I don't know, underserved, whatever these terms are that people throw around anymore, I always find them very. Uh, I get disturbed by this stuff because it's like, listen, you could spend, like, you don't need me, you don't need John Ulzheimer. You can go to FICO.com, you can go to Experian, and just take an hour or two and read, and you're going to understand a lot of what you need to understand about how this stuff works. So to be posting and decry that this is all some big gimmick or scheme or whatever, that the credit bureaus are ruining people's lives. Granted, I get that I went to that spot in my life where things went south, but it was my fault. It's I don't vilify creditors or the bureaus or the market for what happened. It's everything is, like you said, everything is optional. These are all choices that we all
Yeah.
make.
I've
And
I've I have very little sympathy or patience for people like that who, well, no one taught me how to manage credit in high school. Really? No one taught you that there's a date and you have to make a payment by that date. Does that really require a year of academia for you to? You had to be in class by a certain time every day, right? 9 o'clock class starts. You have to be in class by 9 o'clock. There you go. There's your firsthand real world experience on having to do something by some time every day or every single month. But I don't buy this whole no one taught me how to use it. No one taught me how to manage credit. This is not something that requires. You know what? The overwhelming majority of people in this country have good credit, and you know what? You never hear
yeah,
from them. And you know what?
right,
They also didn't learn about credit in high school, middle school, college, postgraduate, because that stuff doesn't exist, right? There is no academia based, personal finance is. I mean, I've taught some of these courses in college, and respectfully to the kids who have, they don't even know what insurance is, right? They don't know what a 401k is. They don't know what a mutual fund is. They just know that they have rent, and the rent is due by the whatever day of the month, and they're supposed to slide it in some envelope in the property manager's door. That's the level kind of their understanding of personal finance. So they don't learn it even in really good colleges either. So this is learn as you earn type of stuff. And to so stop blaming some lack of a class that taught me I had to make a payment every month by some date or I was going to get in trouble. There it is. I just said it in a sentence and saved you tuition. Um,
right.
take take it seriously when the lender says they want X amount of money by Y date, or they're going to start taking punitive actions against you.
Yeah, Scott, that's true. I mean, I went to that school myself. The School of Hard
Yeah,
Knocks
me
will
too. Me too.
break
I
your
had
head.
my first credit card. I my first credit card was back in the day where they actually sent you the card. They didn't send you an invitation to apply. They didn't send you a pre-approved offer. They just sent you the card. And they're like, here you go, John. Here is your credit card. So I had a credit card waiting for me in my student mailbox at college from Citibank. There are no Citibank branches in the state of Georgia, and there weren't back then either. So I'm like,
Yeah,
oh, $300 credit limit. How much beer can I buy with this? And I immediately maxed it out, and I
yeah,
paid the minimum payment for however many years. And so,
right.
to use Scott's very good point, I went to the School of Hard Knocks and learned about interest the hard way because I paid interest.
Yeah,
So, but I don't want that money back. I signed an agreement eventually, and I didn't read it, and that's my fault. It's not the bank's fault. So, but some of the stuff you have to chalk up under the column of common sense, right? Don't drive your car into a wall. Don't jump off a bridge. You probably should stop at 3 beers. You know, there's some of the stuff you can't blame. No one told me not to do. You can't really blame everything on the fact that someone else didn't tell you to do it or not do it. Some of the stuff is just so fundamental. You know, I'm not going to pay my lender because no one verbally told me that I have to do that. That's to me, that's not an excuse. That's it. It falls on deaf ears, and you don't come across very sympathetic.
Yeah, and there's a lot of that right now that I'm seeing. Is there's the sentiment out there is that, well, I was preyed upon. I was, I got a raw deal, and
I don't even know what that means. What does that mean? I walked into a lender, I applied for something, I signed a document, but they preyed on me. I don't understand. What does that mean? They preyed on me. I don't know what that means.
Well, I'll tell you what it translates into is
okay.
I made some agreements that I didn't honor some years ago, months ago. Now I want something, and I'm being told no.
Okay.
Because of these things that I conveniently didn't pay attention to.
Okay. Is that being preyed? That's being preyed upon. Then okay.
Well, yeah, right, and I mean that's sometimes the attitude that is taken not by everybody, at least in the credit repair space that I'm in, but I don't know how many conversations I've had over the phone with people doing a consultation. It's at least 15,000, maybe I don't know, maybe 20,000. Yeah, actually, probably closer to 20,000 when I think about it. But you're always going to get that percentage. And I'm just going back to the comment, the person that ranted on our last live or 2 lives ago, whatever it was. It's like, hey, this whole thing is a big racket. Credit bureaus are ruining people's lives. And I've learned not to respond to this group anymore because all they do is just double down. I mean, arrogance and ignorance tends to go. They're like bedfellows, but it's not the first time that I've heard that. So, yeah, right, Scott. Like,
I'm going to ask you a rhetorical question that I already know the answer. I already know the answer to this. Other than payday loans, what is the most vilified form of credit?
Other than probably credit cards, I think.
Other than payday loans, the most vilified form of credit is credit cards, right?
Yeah, sure.
It's vilified because it is absolutely possible for people to get into a ton of debt. And unless you have payday loans, your credit card debt is going to be the most expensive debt that you're going to service. The average interest rate on a credit card, it varies depending on what source you look at, but it's between 16 and 18%. No one pays that on a car loan unless they're crazy. And certainly no one pays that on a mortgage loan, even if they have, really bad credit.
Not since the 80s.
Yeah, and retail store credit cards, the interest rates are always in the 20s, 22%, 24%, 29%.
Right.
And we gladly pay it, but and then we vilify the card issuers for charging it. But other than the no interest auto loan, which is only available from your captive lenders, and it's only available on certain makes and models, and it's only available if you have good credit, and it's not always available regardless of those 3 things. Other than no interest auto loans, what is the only form of credit where interest is optional?
Exactly.
Credit cards.
Right.
Credit cards. It is entirely, and I'm not talking about the 0% APR, 16 or 18 month, no interest. I'm not talking about that stuff. I'm talking about a garden variety retail store credit card, gasoline credit card, or a general use credit card like an Amex or a Discover or a Visa or a MasterCard. Interest is entirely optional. You choose to pay interest because you choose to charge more than you can pay off every single month. And so you're essentially getting from what the credit card issuer is giving to you, depending on when you make your charge. In other words, when you swipe or when you chip or when you do whatever, the credit card issuer is giving you, at minimum, a 21-day free loan, and at maximum, a 51-day free loan. And as long as you pay off that loan between, 21 days if you charge it on the very last day of your statement cycle, 51 days if you charge it on the very first day of your statement cycle. You're going to get between a 21 and a 51-day free loan. That, other than HELOCs, I guess, that doesn't really exist anywhere else in the world of consumer credit. So
not just a
I,
free loan, but
yeah,
if you're playing it smart and you're a transactor, you're going to get some. You might get some cash back rewards at the same time.
you're getting points, you're getting miles, you're getting, hotel what at points or
Yeah,
loyalty rewards, cash back. You're not getting a tax benefit, obviously, because interest on credit cards or usage on credit cards, there's no tax benefit like there is on a mortgage loan or a student loan, or a HELOC, debt on a HELOC if it's secured by a house. But again, free money, I mean, there's really not much better than free money, even though it's between 3 weeks and 51 days of free money. So
yeah.
if people would just think about credit cards like that, like, let me just use this thing strategically. So don't make this charge today, because then I'm going to have a 21-day free loan. If I wait till tomorrow, I'm going to have a 51-day free loan because I'm at the beginning of my statement cycle rather than the last day of my statement cycle. If they would just think about it maybe like that, you could start to see how you can actually kind of twist and leverage the industry to your benefit rather than just kind of functioning in it and then complaining about it and carrying around cardboard signs in Washington.
We got my girlfriend Jennifer's got a friend that she works with that came over last Sunday. I think she's about 40. She's a little bit younger than us, And I don't know how we got on this subject, but she said, yeah, she goes, I learned really early on that how credit cards work. So she's been with Costco. She works at Costco. She's been there for like 20 something years. With her first job, still there, does very well. And she says, I got my first credit card when I was 18. She's 41 something now. She's like, in all of that time, she goes, I don't use cash. She goes, if I need to buy a stick of gum, I'll use my card. She's like, since I've had credit cards, she goes, I have never once, not once, paid interest. Nobody has gotten a dime of interest from me yet, which is pretty incredible.
Awesome? That's awesome.
That is amazing. Yeah.
And you know what?
By the way,
I guarantee you she didn't learn that in a class. She didn't learn that in credit scoring 401 in school. She didn't learn it there because that class doesn't exist.
No, she said that her mom just sat her down and just said, hey, by the way, this is some pretty important stuff you want to learn. Here's how credit cards work. It was probably a short conversation. And she read what she was getting into. And my hat's off to her. That's pretty impressive. I don't know that I've met another person that has gone their entire life, used credit cards purely strategically and has never paid, assuming it's true, but I don't have any reason to doubt her. We've known her for a while.
So I think the last frontier is valets. So if you go to a nice restaurant, you valet park your car, or if you go to a hotel and you valet park your car, if you go to like where you're at a casino, I guess you can valet park your car and you come out. Yeah. Obviously, you want to tip the valet. There's finally some restaurants in the Atlanta area that are letting you Venmo the valet tip, which is awesome because really? Then yes, and I mean, so that's I think to me that was like the last frontier of cash. Was I would always carry around cash because I always want to be able to tip if I happened to go somewhere where I valet parked my car, because no one else wants cash, but valets will happily take a 10 or a 20. But now there's the places where I tend to go, you can now just kind of scan the side of a little stand out there and you can Venmo 10 or $15, which I think is awesome, because I'd love to get to a day where cash is like, you see it in a history book, but you don't really carry it around.
Yeah. I don't know. I like the feel of cash, and, living in Vegas, I mean, we don't gamble or anything like that, but we like people watching and the nightlife a little bit. So yeah, I've always got cash for waitresses and waiters. All right. Where are we, John? 40. Yeah, we're 45 minutes into it. Just as we're about to drop off, Isaiah sends in something. Account was fine. Yeah. So Isaiah, this is more of a credit repair question. We don't really cover this stuff when we do more of the credit coaching, credit education. But if you want to send this to support at creditversio.com, just paste it into an email, send it to support at creditversio.com, and either myself or Travis will answer it. All right, John, thank you so much. I appreciate you joining me today. Kind of a quiet day today. I think maybe I don't know, something's
That's
going
fine.
on. Or, yeah, who
That's
knows?
fine. It's the first day of the month. I know we have a lot of people that are self-employed who watch us that run different types of companies, and today was the day they sent out invoices, and so it's good every once in a while to have a chill day.
Yeah, yeah. Perfect. All right. Thank you so much for joining myself, John, today. John, we'll see you in a couple of weeks. Thanks,
All right,
everybody. Take care.
thanks, Sean.